Hey, good afternoon, everyone. Thanks for joining us today. We'll get started. We have a bunch of people popping in here. We'll get started in about 30 seconds to a minute or so. Thanks for joining us today. If you did anything outstanding over the weekend, share that with us in the chat too. Appreciate you being here on a Tuesday after a holiday. Did you do anything big, Pat, over the weekend?
To my cottage, and I had my granddaughter up there for the whole time, and she's a 3-year-old, and we had a wonderful time.
Oh, is that your one and only?
Yes, I got another one, grandson gonna be born in October, but right now Cecilia is my true joy in life, and whatever Cecilia wants or needs, she shall have.
The grandpa's a little.
We have a big playhouse in our backyard that has been dilapidated for years. It's up in the tree house. It's even got electricity and all this other stuff. And last weekend, she takes me by the hand. She goes, "Papa, come here." Yes, she says, and honest to God, she says this. She goes, "I need you to do something." And I'm like, "Yes, Cecilia." She points at the playhouse. She goes, "I need you to fix that." So I had a guy out, and he says it's $5,000 to make it workable. And I'm like, so cheap for her? Yeah. So we're gonna have a playhouse.
Yeah. That is absolutely positively awesome. That's the one thing that I'm missing from my life. Like right now, everybody that knows me knows that I so want to be a grandma. It's like high on my list, and I'm not sure I'm gonna get that. I do have a grand puppy, but it's not quite the same.
Yeah. All right, being a grandfather, for those on the call that know this, it is so much better than being a parent. Oh my gosh, it is light years. It makes it just about worthwhile raising those 6 kids and the pain and suffering that went through that, and all this gray hair. So I'm happy now after all the years of pain.
That's fun. That's fun. Well, thanks everybody for joining us today. This is the last week in Mortgage Today. For those of you that I have not met, I am Faith Howard Mooney, SVP of Member Engagement at the Mortgage Collaborative. And today I have with me Pat Ervin, who is the EVP of Independent Bank. And thanks for doing this with me, Pat.
My pleasure.
I always love having you on because I know I'm going to have like a really honest conversation with someone, because you usually aren't a mincer of words, and so I always appreciate that because I'm kind of that way myself. So
well, that's what I find in the mortgage business, though. That's one of the reasons I enjoy this business and be a competitor or whatever. I mean, I think that we're a business in particular that doesn't have time for BS. And when somebody tries to pull a corporate ease crap on you, it doesn't go over. And that's why, you can speak the language, and the language in our business is just it is what it is. And, let's deal with it. We all know that we follow a lot of really stupid rules. And we can have a beer and talk about how stupid the rules are, in some things. And then the next day, we're all going to go to work and follow those rules. So it's just the reality of it. But
so true. That is so true. So so everybody, kind of the people on the call that don't know you, share a little bit about Independent Bank for us.
All right, I'll just keep it tight to not bore the heck out of people. So Independent's a $5 billion bank in Michigan, and we have about 60 branches here, and I'm responsible for mortgage lending. And the unusual thing about this particular bank is a commercial bank, but we actually have a 100% complete mortgage operation, including we service everything ourselves. We FHA, VA, USDA, Fannie Freddie, I mean, everything we service ourselves right in-house, no sub-servicer. And we don't give a whole lot of business from our branches. It's all about hunter killers going out there, and on 100% commission and bringing business in, and and then cross-selling checking accounts and doing all that. So it is a mortgage operation that is in a commercial bank, and two very different cultures.
Yeah. You would be probably run the mortgage operations maybe a little bit more like an IMB than
Yeah.
most banks do because it's just not structured the same way. So
Yeah. Yeah,
that
that's it. It's a sales culture, that's different than the bank culture, and we get along. Uh, most of the time, everything works out. But it's a department. It's not a mortgage company. It's actually a part of the bank, and so that's a little bit different sometimes, the different structures. But we're out there slugging it out like everybody else is right now, and we had to go through cuts, and we went from about 230 people in the department down to about 92 right now. And we had to do some painful stuff like everybody else did. There's no hiding out just because it's a bank and so forth. All of the bank's doing well, which is it's nice to be part of an organization that overall is doing very well. So it's good.
Yep. So you're on the street just like everybody else is doing the battles and trying to find the business, just like everyone else. You and I both had the opportunity last week to be in New York City at MBA secondary. But before we get there, Navi had a question for you. Curious, how much volume does your bank do with 92 people?
Uh, well, this year we're budgeted for about 600, but I think we're going to come in short of that. We're going to do somewhere around 550.
Yep.
And about 30% of that is going to be portfolio loans. The rest of it is saleable.
Okay. Let's go to, he says, thank you. So let's go to secondary. I unfortunately didn't have the opportunity to attend a lot of sessions, but I know that you were in a couple. And of course, I asked questions of everybody that I knew well there about kind of like what the mood was and what the, important things that you heard. And one of the things that we were going to talk about today is the CFB session, as well as, if you have any feedback from Bob Brooksmith opening secondary, would love to kind of hear your takeaways from being there.
So if you've never been to one of these things, it's an MBA event. Years ago, Bob Brooksmith, is the head of these things, and then there's a president that rotates out every year. And so Bob's kind of the voice. He's the David Stevens now, what David used to be, and he would give some very well planned out, well scripted opening remarks, and it was pretty much. Yeah, you know what? I would go, I wouldn't go. Didn't really matter because you knew what was going to be said. Okay. But Bob, over the last couple of years, and I think our friend Rohit Chopra has helped him along these lines. Bob is now kind of throwing away the pre-scripted talk and gone off off the rails a couple times, and rightly so. Is calling it as it is. And I complimented Bob, a couple of times I really encourage him. Bob, let's call it like it is. Let's take this thing on because there are forces at work that are crushing the U.S. housing market, and there's self-inflicted wounds that are taking place, and we're all the victim of it, and buyers and sellers are victim of it as well. So anyway, so Bob started off this year, and he really was strong, and he talked about the CFPB calling us, they put out a blog, which is the way they kind of project what direction they're going in. And if you haven't read it, well, don't read it before bed because you won't sleep. But it accuses us of an industry of charging so many junk fees that pad our profits and ripping off and taking, the customers, which the breadth of the ignorance involved in that is remarkable because here we are in an industry that the MBA's quarterly data shows that for the last 7 quarters, this industry has lost money. Last year, if you owned a mortgage operation, on average, you would have been far better off to just not be in the business, period, because every loan you close costs $2,000.
Yeah.
So we are writing checks in order to provide financing for America as an industry. And yet this major regulator comes in and starts accusing us of padding our profits. Well, you got to have profits before you can pad them. And so Bob took off after that. And then it was fun because later that day, they brought in Rohit Chopra and he gave his talk. And again, he used to be far more just off the script, but he also was kind of wandering from the script a little bit. So you're starting to get to an actual conversation, and then they did a question and answer. And there, Bob had him on the stage, and he tried to pin him down on this article, this blog, or belief that the industry has all these junk fees. And so what he pointed to was credit reporting fees. Okay, and of course Bob was saying like, well, you may realize that these have doubled and tripled and quadrupled over time, and this industry is not actually making money off of credit reporting fees, but that passes through. And so Schober did a quick turn and came back and said, well, I'm not saying that you're doing it, but I'm just saying the overall fees for the industry are too high, and this is a great example of how they're too high. And everybody says, well, we agree, but you're the one who allows this to happen, because you are the ones, along with FHFA, which we kind of put in a bucket together, right? I mean, this is the regulatory government body, and they're putting these together, and they're allowing this monopoly to abuse its power. It's a monopoly because they created it, right? I mean, we have to use these credit reporting agencies,
Correct.
and when they double and triple their fees, we have to pay them. So anyway, we got into it, but I think the good news is, I was talking to Bob later, and so as I'm sure everybody in the call already knows, there's a bill in Congress that would. Oh, I'm sorry, I'm getting my subjects mixed up. That's not my next subject. No, this one. The good news on this one was that Rohit Chopra went away, and basically, you're sure you saw it in the industry news, that he's kind of throwing a shot across the bow, saying that they're going to start really looking hard into these credit reporting fees. But, you know, it's not just the fees. It's not just how much they're charging us. It's how we also have to do this two-step around these trigger leads.
Uh,
And and here, this group is called the Consumer Financial Protection Bureau, right? I was on the advisory board of the CFPB for 2 years,
yep.
and it is designed to protect consumers, right?
Which
And
we
yet,
all want. I mean, there's nobody on this call. There's really nobody in our industry that doesn't want to do that. By the way, before we move on, they just came out with the first quarter 2024, and while it's not $2,000 on a loan, IMBs are still losing $645. I saw it just this morning, $645 on a loan. So you can't go back and say, well, that was before and there were other extenuating circumstances. It still is what it is today. So let's talk about like your time spent with the CFPB and on the advisory panel a little bit, and kind of what you enjoyed about that and what you gained.
first meeting was in 2019, and Kathy Kraniger was she was the director of it, and she was firsthand involved with us as we had the meeting. There's 3 different advisory boards. There's the one I was on, was the Community Bank Advisory Committee. It's called CBAC. They had one that was a credit union specific advisory group, and then they have a community, which is like the activist groups advisory board, and your term is for 2 years. And so the first couple meetings we did in person. They're supposed to be in person every quarter, and they started out that way, and then COVID hit, and everything else was virtual. So we lost some of the effectiveness that way. And when finally, after a year of that, then the changeover in administration, and the day that President Biden took over was the same as the last day of Kathy Kraniger, and they swapped her out. So I would say the tone changed from a very effective communication, really valued our feedback, really a balanced approach to regulations and projecting what is going to happen before it gets enforced. That changed to what we have today, which is watch me bust people, and then you can read the tea leaves to see what the rules are going to be. And so they call it regulation by enforcement. And so I think that CFPB is changed dramatically, and I don't think is better for us or for customers.
Yeah. Environment, definitely different. I did see in the news this morning as well that with the approval of the ownership there, that the statement that came out was, we are going to proceed and you are going to continue to see more enforcement. We're going to continue with enforcement opportunities. I did see that as well. One of the things that you alluded to a little bit before that we were going to talk about today is, something that we've talked about a lot, but it does appear like maybe there will be a solution, which is trigger leads.
It just enrages me that trigger leads and the Consumer Financial Protection Bureau have lived side by side for the last 10 years, and there doesn't seem to have any problem with this. But I mean, you have to guard our customers, all of us on this call. When a customer gives you all of their financial information, right? I mean, we uncover every single thing about you and how closely we have to guard that. And I know everybody on this call has all sorts of procedures to make sure that we guard that. And on the other hand, as soon as we pull a credit report, they're broadcasting to the world, anybody want to rein in on this customer. And I know, this is another one where you just can have a beer and everybody can sit around. We can talk about who got the most calls. I have one customer verified that got 102 in the next 72 hours. Okay. That doesn't include mailing. That doesn't include emails. It was phone calls on his cell phone, 102 in 3 days. And that's high, but having them in the 50s and so forth is not. So we have to jump through the hoops. We're doing soft pulls, which we can't charge a customer for, and then we're counseling them to get out of the program. But the good news is that now this one's the one I was referring to. There's a bill in Congress, and it's making its way through. The MBA is pushing hard, and it's going into rules writing in the beginning of June here, which I guess is one of the steps it has to go through.
Right.
And so I think the MBA is optimistic that could get through. They always give the improviso that, listen, it's an election year, and even something that everybody on both sides of the aisle would say, absolutely, let's do this. So it might get through, and that could solve a whole lot of issues. In the meanwhile, we're all trying to do a two-step to not have this happen to our customers. And I've talked to a couple different folks, and TMC set me up with some other competitors, and we talked about it. And some, it's a broad range of how these things are being handled at different lenders. Some of them are just doing a hard pull right out of the gate, and they're just telling the customer, button up your chin strap. You're about to be used and abused for the next 72 hours or so. And they're just proceeding. Others are doing soft pulls like we are, and and others are trying to do a single bureau soft pull, not do the tri-merge. We do the tri-merge only because you got to get a legit reading out of the AUS, and we just had to raise our overall fees to cover that cost that can't be directly passed on. So I don't know. Haven't heard any solution that is exactly right. I will tell you, I was at the MBA last year, and I had a meeting with Equifax, who's our provider, and these wonderful folks offered to me. They had the cojones to sit down at a table with me, and they had a solution for this trigger lead problem. And if I just paid them more money, I could implement their solution for the problem that they created, and they could double dip on both sides. And they thought that was a wonderful idea. They were so excited to tell me. Now, after I ripped them down to their bare bones, they didn't even give us a nice gift for coming and having a meeting with them, which apparently the people I was with were upset about, because apparently Equifax gives out good gifts. So we didn't get any gifts. But I told them what they could do with their solution to their self-made problem. And
but one of the things I do love about you is you never have to wonder where you stand. You are very honest with people, and I always appreciate that. I feel like our providers, and we've got 3 good providers within the network. You had the opportunity to talk with some individuals who use some of them and some of the solutions that they've come up with. Your New Yorker friend, Amy Bohr, says that we could be really good friends. We call her the Velvet Hammer.
Now, listen, during that talk, though, I said it 3 times that it was not personal, okay? I didn't want them to go home and weep or anything. Everything it's just professional,
Yeah,
nothing personal.
I think everybody understands that. You just want to share how you really feel about things so that they have a good idea of where everyone is coming from. But I do feel like that they're passing on fees that they're not necessarily Equifax. I have not had any exposure to them, but I feel like our partners, the partners that we have within our network, have been really working hard to try to find a customized solution for each of our lender members within our network and provide them as much guidance as they can so that it fits into their process, which is what you said. Not everybody has, there is no one solution for every lender
Right.
out there. You kind of have to go with your gut and what works best for your culture, your employees, your whatever budget, and what you have to work with. But I do know that we do have three strong credit providers within TMC who have been working very hard to try to find the best solution of the ones that are out there for
So the
our.
bill comes through. Once that bill comes through, it'll clean up for all of us. So could I talk about a different subject that I think is going to have an impact on us?
You absolutely.
So, and this is the ROV, right? The
Yeah.
reconsideration of value rules that are going to be implemented later this summer. I think that's going to have an impact. I think that at the end of the day, for those of us who have been in the business long enough, we recall how we hung appraisers out to dry in the financial crisis because we accused them of all overappraising and putting too high values on properties, and we just beat that industry up nothing, silly. And now we're going to go the other way, and that is anytime an appraisal is going to come in light of purchase price, I promise you, if at all possible, this channel is going to be used. And I'm actually in the middle of one right now that they came back on. And this one, the realtor has both sides of the transaction, and up the sales price from 55,000 to 58,000 just to get more money back in. And I suspect to pad the commission more. But we're going down the path, and I just think what's going to happen is appraisers are not idiots, and they're all small businesses. You might have one, two, three employees, and they're just going to say it's a heck of a lot easier just bring the thing on value. You know, why go through the pain and suffering of bringing something in, that's under or that you believe is correct but is undervalue, and I think that's just going to happen. So you're going to have this. You have two things happening here that we beat them up their high, we beat them up their low, and I think we're taking the teeth out of what this appraisal should be. This should be an assessment of the value of the collateral that we are putting a loan on, and an assessment of that real time. And so I just think that that's one that is kind of going under the radar a little bit, but God help an appraiser that brings in a value light, and there's any possibility of trying to put an ROV behind it. You're going to have to deal with it. It's going to be expensive, time consuming, and risky. So
Yeah.
that's what's going to happen.
I was going to say, so I came from the appraisal space. I spent the first 25 years really of my career in mortgage in appraisal. So I was one of those people that was in that world when all of that was going on. I did work for a management company, so we weren't a small independent, but it's a hard business to be in, number one, because it seems like nobody's ever happy. So it's a very, very hard, tough business to be in. But
I
yeah,
like the comment. I like the comment here about my Z estimate is so much higher. Yes.
from from your counterpart, Brian Trailer.
Yeah. Yeah, that's right.
Could have beverages and some really, really great conversations, I have a feeling, if you haven't done so already. But yes,
Another one, here's another trend I think just want to touch on. That is this dual role coming up, where it's more acceptable to be both realtor and lender.
yeah,
So if you had, Brian Levy has his, newsletter he puts out there, and I was just reading his take on it. But I tell you, I think that could be a little bit of a fad that we go through when a lot of people are trying to jump to that. But I really do think, because having been a realtor, having my wife as a realtor and as a lender, uh, you're going to hear about the transaction. You're going to hear about the one that everything went beautifully, and some guy got commissions every which way he looked and made all this money on the deal. Okay, that's going to be the exception. That's going to be the one you'll hear about. But the reality of it is juggling both of these responsibilities at the same time and doing a good job at it, and then doing a good enough job that you can repeat it to get to it's not one deal, as we all know. It's about making a livelihood that we're after.
Right.
To do that enough with high enough frequency, high enough competence and repeatability, I think it's a fool's errand to try to combine those things. I really do. But
So
many will try.
I was going to say, question to you, because I mean, we hear different things. So we hear that, some people are heavily promoting that to have, better, stronger, um, you know, relationships with people. And then other people are of a very similar opinion that this is something that is like a short-term thing. It's not going to get traction, that type of thing. Do you think that so my thoughts on it are people are going to be the real estate agent, they're going to have the lead in, they're going to get licensed as an LO, but are they really going to do all of the things that an LO would normally do? Are they still more of a lead generator with a deal that comes in, but they haven't really served the same purpose as an LO? That would be my concern. Is that what your concern is as well?
Well, I think there's many ways that you can screw this thing up. And yeah, you could try to just be a front LO where you're literally passing it through. And again, it works. Maybe it works 2 out of 3 times. But see, the third one that blows up is an interesting thing because now you have all sorts of liability hanging out there.
And
You
you're on
know,
sides of it.
yeah, and you are the one. And by the way, making that big let's just say everything works out beautifully and you make some big commission on a single transaction that's all over the place. Uh, that comes with it some responsibilities as well. And in
Right.
today's environment, state regulators, all sorts of folks would be very interested. Anybody who's putting an inordinate amount of money in their pocket based off a single transaction that maybe was with a first-time home buyer or a seller that was uneducated or didn't know. I mean, there's a lot of different twists that go with this. And the other thing is, we all know because we're in the mortgage business on this call. Okay, if it was as easy as just going through a computer system or doing something like that, then none of us would be employed anymore. Remember, they've been projecting our death in this business since the 90s. Same thing with realtors. But fortunately, this is the fortunate side of this. It is so complicated because these regulators got their head so far blank up there, what, that they make it so difficult that it is not possible to have an entire business run on some automation that just flows through smoothly on every deal. As soon as you think you have an assembly line, the first deal shows up and you realize that you're actually manufacturing snowflakes and not actually, have some stamped out, process. So,
Well, now
so
I think,
anyway, that's my thought on it.
I mean, the other thing about that too is like going to a full automated process. Now the regulators are coming out with concerns about, is AI tainted and discriminatory? And I mean, it's all some of the exact same issues of things that I feel like were supposed to be addressed by having an automated process now are coming back as, maybe they're not really fair because of how the rules are written, as well. By the way, you have another Michigan person who is right in the same place with you are, Mark Renault, who is typically always on this show listening in, and said that he has not seen a realtor to be a successful lender in his 34 years. Agrees with you that you are spot on with that thought process as well.
Yeah.
So yeah, it's a tough spot to be in. I feel like a lot of people may try to do it, especially if with the NAR settlement, if something happens there that they know they're going to lose money, they're going to try to do it as, an income grab maybe, and think that it's going to be easy. But for the LOs that I know that are the really good consultative LOs, they didn't learn what they learned and how to counsel people and get people in a good spot overnight.
Yeah.
So the learning curve is I feel like to be a really good LO, the learning curve is a steep one at first, and I'm not quite sure someone can do both of those roles at the same time and do them both extremely well.
No. The NAR settlement, the word came out now. August 17th is the date of settlement now. It's not July anymore.
Okay.
And
Not
that's changed a little bit. But remember, the only thing that's actually changing by the agreement is they can't put the commission on the MLS anymore.
right.
It's not clear. They can still probably put it into the comments section in the MLS where the realtor makes comments. And my prediction, which, who knows, good as anybody else, I guess, is I think that there'll be some bumps in the road, some people, because the press will all be around it. But you come back 6 months after early next year, things will be just the way they are today. Uh, with the one exception, and this should have never been part of somebody's business, you should always have a buyer's agreement. It always should be a contractual arrangement that has a fiduciary responsibility to that buyer. So that'll be now happen regardless. You won't have an option as an agent, which is a good thing.
Yeah.
But when it all said and done, if the 3% for the buyer's agent or whatever was always overblown, was not necessary, it would have washed out of the market long ago. There's been plenty of options, and yet it has held firm. So market forces will prevail, and it'll wind our way around, and things will be okay. It's not the end of the world again.
We'll still be here.
Yep. Yep.
We'll still be here doing what we do every day. Well, we are at the end of our time. I knew this would happen. It always does. It goes by so quickly. Come back anytime you want. I always appreciate talking with you, having your feedback. We have even if we didn't agree, we have some of the best conversations, which I think is always what it's about. Appreciate you being in our network. Appreciate you doing this with me today. We love having you around, and we didn't talk about it, but TMC will be in DC. June 4th through 6th. Pat is going to be on that trip. I am not going to be there, and I'm so sad because I always love to listen into the conversation of our lender members with the agencies. So stay tuned. We will have to do some sort of a debrief call after you guys are there to share feedback that you got representing your companies and our network. So appreciate.
Faith, are you going to pay the bail to get me out of prison once in these meetings? When they drag me out,
Morning.
and
I'll have to tag somebody to that.
Okay.
Well, Amy and I will find somebody to tag to that responsibility.
Good. I'd like to get back to see Cecilia sometime. All right. Who says don't? Oh, Amy says don't tarnish your rep in DC. From what I hear, that's going to be difficult to do. So you'll be fine. We'll represent well. We can ask questions.
Represent well.
Make suggestions
about it. Well, thank you so much, Pat, for doing this with me today. Appreciate you. Let us know what we can do for you.
All right. Thank you. Have a great day. See you, everybody.
Bye.